We have assembled an all-star Fox panel to talk about this wild day for the markets.
Our own Liz McDonald, independent trader Eric Bolling, Victoria Barrett from Forbes, Gary Kaltbaum of GaryK.com, and Peter Schiff, author of Crash Proof. I want to go to Eric Bolling first because he's a guy who spends a lot of his time in the pits. Tell us what those pits are like right now with all this craziness.
Well, interestingly, one of my big notes here is what happened today? What happened today? Why is this different from 1987? The difference here is that electronic trading is so prevalent. What's going on is you're seeing these index funds, the S&P futures and NASDAQ futures and the Russell futures, push markets down overseas through the night. I'm watching this thing all night. You know, at one point we were almost 600 Dow points lower early this morning. And that's because the S&P futures were limit down. They were locked limit 70 points down. What's happened? You have a lot of young traders. You have a lot of young hedge fund managers saying, I got this huge portfolio. How do I hedge this? I got to hedge my downside. They've never seen this before. They weren't around for 2000. They definitely weren't around for 87. So they're just selling index futures. So then you get this huge volatility in the index futures, and it's the tail wagging the dog, David. The index futures are actually pushing the Dow stocks around through that index future mechanism. I'll tell you, very, very treacherous, volatile, scary markets. I've traded both 87 and 2000. I've never seen anything like this. If you don't have to trade, step back, take a breath, and take a look at this later.
Gary Kaltbaum, you predicted last week a little early, but then you restated it yesterday that we would absolutely see a Fed fund rate cut before the market opened today. You were right, but the market didn't seem to embrace it that much. What did you think?
And I also had the Giants against the Packers, too, so that's real important.
Perspective.
Look, you know, the big thing that you need to know is the Fed's just been so way behind. The 2-year note is trading at 2.3%. So there's a way to go. The Fed's going to cut another half point at the meeting. They're going to go down to 3 because they're just way behind the curve, and that's why the markets have been getting hit.
Fed funds futures pits are saying quarter point.
Yeah, they're wrong. Look, the bottom line is the Fed's so way behind. The reason why the market's getting kicked in the teeth is because the market recognizes that the Fed can go to 2.5 and still be okay at this point in time. I'm actually hoping it. As far as today, you know, there's too much talk about today. That's the trees. The forest has been this whole big giant top that's been put in place in the market, and I don't think that's ending soon. I think we could rally some from here, but after that, I think we're going to head lower again.
All right. Well, another one of our contributors who saw a lot of this happening before did, Peter Schiff, joining us now. No surprise to you, Peter. How much further down do you think it's going to go?
Well, you know, if the Fed hadn't been as irresponsible and cut rates today, the Dow would probably be down 1,000 points today. But that doesn't mean that the Fed should cut rates. I mean, the problem is rates are too low as they are. You know, we don't need another Alan Greenspan at the Fed. We need another Paul Volcker. We need somebody to actually do the right thing and raise interest rates and stop inflating and let the chips fall where they may. Let the market go down. Yes?
Do you think the Fed should raise rates today?
Yeah, they should have raised. Well, look, we shouldn't even be in this predicament. They should have raised them a long time ago. But better late than never. They're going to have to raise them eventually anyway. And the longer they keep them low, the higher they're ultimately going to go, and the longer they're going to stay there. We got to get our house back in order. We need more savings, not more borrowing. We need to start producing again.
Let me jump in here with Liz. Liz, is the Fed covering up? In like a cat box, just trying to cover up something that we really should just get the heck out and
that is the debate. When you saw that, what's interesting though, when you saw the Fed cut back in December, right, a quarter point, what did the markets do? It plunged 300 points because the traders felt that they were betrayed. You know, but really, is this having an effect? You watch what happened since August when the Fed started cutting. You know, the credit markets didn't move. What you see now, though, is the auction facilities over in Europe really making an impact on a very important number, and that's the LIBOR. LIBOR is now down around
the London
interbank offering rate, and that's now 3.89. $385 billion in adjusted rate mortgage resetting next year tied to LIBOR. That'll help a lot of consumers with their mortgage payments going forward. So, you know, the real issue is unlocking the credit markets so banks lend again. And you still see the junk bond yields very high. You still see those rates very high about which banks are lending to each other. So, you know, will it help? It has great psychological impact. I'm not that optimistic about it.
Victoria, are we expecting too much from the Federal Reserve right now. It has two responsibilities: maintain the price of the currency and stimulate growth. Perhaps we should just focus on the first and not the second.
Well, certainly we're not focusing on the first at all right now. The Fed is in a bit of a catch-22 because the consumer is weak, but so is the credit market. So what they're betting is let's lower interest rates. That's going to inject liquidity into the market. And the dollar is going to fall. But let's hope that that liquidity is going to have a greater positive than the negative of a weaker dollar. Because for the consumer, a weaker dollar isn't good news. That means our oil is going to be more expensive.
Why are lower rates, though, going to encourage somebody to lend when they get a lower return? And why would somebody want to lend money to Americans anyway? And when we've already borrowed so much money, we can't pay that back. Why would you want to lend us more, especially at low rates of interest?
Business lending.
Well, I mean, but they're trying to get money to the consumer. Businesses, right? But businesses can borrow money for legitimate purposes. It's American consumers that can't get more loans. That's what the government is worried about. They're worried that Americans are going to stop spending, so they're trying to get more credit to the consumer to keep buying. But that can't happen. They're tapped out, and no one's going to lend money.
You want to fix this? I can fix this real quick. The SEC could step in tonight, and say, you know what? We're going to reinstitute the uptick rule, which means you can't short a stock. On a downtick, you have to wait for an uptick to short the stock. Number two, wait, time out. Listen, the ECB can join in, or the Bank of Europe, either one of them, can join in and say, you know what, we're going to lower our rates as well, because we see that this could be a global phenomenon. If they lower the rates, all of a sudden you have a little bit more of an equal playing field, and then you see some
guys, we got to wait till round two. We are facing a hard break, Peter. We're not doing this on purpose. We're going to hear a lot more from you and our other guests in